How do you do, ladies and gentlemen? I'm your host, Seth Julian, welcoming you to this week's weekly Week in Review. We're going to take a look at what's gone on in the week with our focus, of course, is to see if we can get a handle on what things might look like next week. The first thing I want to focus is a series of charts looking at our indices, these indexes with the exception of the U.S. dollar index. Many of them are doing extraordinarily well. The Tadawul most notably, but that's because over 20.2% of the average, the weight of the index is Saudi Aramco, and as price goes Saudi Aramco, so goes Tadawul. Nonetheless, terrific trade, would you not agree? But the other thing to point to here is the FTSE, very strong in the face of a European land war. This is the dollar index, and that's strong for other reasons. It's not a stock index; that's an index of the U.S. dollar strength. But what I do want to point out is that some of the indexes, this is the S&P, this is the Dow Jones, the Milan, I guess those are both Milan for some reason. The Nikkei are starting to tail off. What is this? This is the NASDAQ. They are starting to tail off. They are early indicators a general decline that we're going to see as a result of the tremendous inflation pressure the economies of the world are facing. And that is most readily evident when we look at this combination of the two bond products we sell here in the house, notably the Euro Bund, which is the German government 10-year, and the U.S. 10-year. As interest rates rise, the price of the bonds fall because their return, their interest, the paid interest on them, the coupon rate, is fixed. So nobody wants to hold a fixed return bond when interest rates are rising. You want to sell this junk, buy the higher yielding product come on the market. Hence we have this phenomena. So these have been trend shorts. In the case of the Euro bond, you can see the 200-day moving average. In the case of the U.S. 10-year, just barely visible. It's long left the 200-day moving average in the dust, well below the 25, well below the 50. Same with the Euro. On increasingly huge volume. These are daily charts. So that gives you an indication of where interest rates are headed, where bonuses are falling to. And that I do want to go back to the essence of what's happening. Let me just take a quick focus on something else on the moment. I know you. This is what's not enough. It's relevant. It's good or bad. It's just what it is. I like to say today. This is this week's updated version of the misery, brutality, aggression that is Ukraine. The red areas, of course, indicate the Russian-controlled. Again, the blue area, most interestingly, is claimed by Ukrainian counterattacks. And the Russians have effectively from Kiev, the Kiev salient. They have been driven from here, and they are going to flow there. They've reverted back into Belarus. They're making a end run here, and they're going to confront the Ukrainian forces that are here that may risk being surrounded. But the area on both sides of the Dnieper are now fairly Russian force free. News, bad news. If you've got family in Kiev, it's excellent news. If you've got family in the Donbass and Lukashenko, the area, that's not so good. But it's getting worse. And I do want to point out that those who thought, you'll always hear people in our day and age, especially as warfare has proceeded far in the background. When it's to the fore, these particular, it'll be over 3 weeks. This is a matter of God. He's going to be a victory celebration in May 9th against Nazi 19. It's going to go on for years and years. And it's going to drag on. It's going to be a long slog. More heavy armaments are arriving via eastern supply lines. Tanks are coming in Czech Republic. The Australians are getting heavy-duty arms and carriers. You don't send that stuff for a war that's going to be in days, months. This is going to be bad. And now we go back and focus on what the essence as traders, and I please do not misunderstand me in saying that the essence of war is money. It's not. I want to be clear about that. Anybody who thinks otherwise is understanding me and my intentions. But as traders, are obligated to take on the markets when we can, and there are some tremendous opportunities to do so now. Most particularly this is a picture of commodities here at the house. Yes, this has been a fantastic trade, up and away, and it's going to continue to do so. Oil has been fooling around, sitting down here, but it's going up. It's taking a breather. The moving average moved up. It's going to go up. We feel. Interestingly enough, gold in euros moving. Gold in dollars. Where is gold in dollars? sold in dollars, not doing as much as dollars strong now as we saw in the dollar. And that largely due to the fact that rates are rising in the United States. And it's a desire currency hold for the carry, meaning that you can just do nothing with the money and you'll make an return. But as the results of raising interest rates to control inflation kick in, the economy is very likely to slow down, and the strength of the dollar. Nonetheless, these are color products. Those of you who have been following coffee and know that that's been a trend and will continue to come. Copper coming back. Palladium, which has underperformed, and I'm still losing palladium, come back, is also going to rise. All of the why that? But Russia is two families of goods that the world has. And the large majority, by far, 75 to 80%, 95% of it, commodities. Goods that come from Mother Earth, that are mined, grown on top of the earth, but that's what she produced. The second one, of course, weapons. You never see other products from Russia that anybody else, even a watch, a bag, a car, any consumer, any product other than a weapon made in Russia. Anybody wants, all their goods are third rate. By the way, their weapons are also not first rate, but second rate, and they're bargain price compared to Western weapons, so they're enough. And they produce them in enormous quantities, so it's probably for them a large scale, and it's cheap enough for their clients, smaller purchasing. So these that we're looking at here are likely to continue to rise. I do want to focus on just a couple of assets before we part ways in the review of the week. This is this phenomena. This is the dollar-ruble rate. Now, we can't trade dollar-ruble. That's been off the market since about here. Slightly because of the risk involved. Most houses won't trade it, including ours. But mostly because it's now illegal. It's legal. It's under sanction. We can't really trade it without fear of sanction. But my point in bringing this map, in this chart to the fore, is that the ruble is now stronger than it was at the outbreak of the war. In fact, the central bank just reduced its interest rate 3 points to 17%, and yet the ruble strengthens. Now, on zippity-doo-dah volume, I hasten to point out, which means that this behavior is largely unexplained from a market point of view. Nonetheless, the chart is the chart, and I point that out just for its own purpose. This is just in passing, of course. This, call it 15% jump, 14.99% jump between yesterday's Thursday close and the opening on Monday, represents Mr. Buffett's Berkshire Hathaway, a $92 billion purchase of. So that was a nice. I think that continue up if Mr. Buffett and his cadre think it's a worthwhile buy. It is a worthwhile buy. And this volume is not explained by Berkshire Hathaway. Other people got on the bandwagon on this, and so I just went with a big development. I also want to point out that, and this, of course, a dollar. I'll get this in a moment. I got ahead of myself. I want to bring things to it shortly, but I want to mention the fact that next week earnings reports. Now, generally, my feelings reports that it's mostly silliness on the part of the commentariat media. They make a fetish out. The only one that really matters is Q1 because Q1 actually the close of the previous year, and that's what traders and managers are their bonuses based on, and so that's really important. The other one is snapshots in an ongoing horse race. However, that is, I say with a caveat this because as inflation rises, we're going to see, or not, and this is what we're going to be looking for, how much ability these corporations have to keep their profit margins as fat as they've been since the recovery in mid-2020. If they pass on those inflationary cost rises, their margins will remain the same. And if they can't, if they have to absorb them because of competitive pressures, their profit margins will shrink. So we do want to pay attention, though not perhaps for the usual earnings report reason, which is that fantastic trading opportunity. I'm not going to go into it now. We've talked about this in many different, maybe we'll do one next week, one of the daily briefings. The setup for trading the earnings report season is painfully simple and usually reliable, though not entirely like everything in the capital market. But we are going to pay particular attention to margin squeezings and their ability to absorb inflation. That being said, I'm going to come to a close with what was the biggest sleeper story in the world last week, but it's going to get bigger and really bigger. The Chinese Communist Party, for those of you who are unaware, is a brutal, vicious dictatorship that fudges its numbers, lies, and cheats its own partners in commerce, and threatens and bullies its neighbors. And this shouldn't be news to you, but if it is, you can go to the bank with that. They have been fighting COVID in a typically, strong, heavy-handed way by locking everything down in sight. They haven't figured out how to live with it yet because they don't really have decent vaccine. They're too cheap. Their healthcare system is way too rickety to be able to do what the Western societies and the developed world have done, which is inoculate like crazy. So the slightest outbreak causes them panic. And up till last month, I would say, 2-3 weeks ago, they haven't had to panic because they've been fairly free of COVID. Not anymore. Those days are over. They've shut down Shanghai. Shanghai is the world's largest port city in the world. Most stuff ordering, leaving from Alibaba gets to Shanghai. And the yuan against the dollar is weakening. Now, obviously, it's right a tear. Keep in mind that the yuan is on the right. So as it gets stronger, the dollar-yuan rate goes down. But as we see here, it has been reversing. It's getting weaker, and we think it's going to continue to get weaker because, excuse me, the Chinese Communist Party, in the body of Mr. Xi, is saying, good or not, and this is an unbelievable statement, it's facing just their own people, which normally is verboten there. It doesn't happen because they kill their people who resist them, or make them disappear, or put them into concentration camps, whatever they do. There's not a lot of resistance there, but it's growing. It's growing because, well, it's just growing, and I want to make you aware of that. That story is going to continue to rise, and that is to be another huge inflation contributor. So the inflation play, the bond play, gold. We are not to mention we did mention the commodities are all in play, and this week's news has had a lot to contribute to that, and next week it's going to all get more acute. So with that, ladies and gentlemen, I'm going to bring this week's summation to a close and wish you all, ladies and gentlemen, the ability to trade with confidence. Bye-bye for now.